Hello dear students, this is Financial Management Tutorial 4. Let's have a recap of our earlier tutorials. You have already learned the meaning of business finance, the need of finance in business firms. You have learned the meaning of financial management. You have learned the importance of financial management and objectives of financial management. You have learned the various financial decisions and how financial decisions influence the business firms. Let's move to our today's discussion. In this tutorial, you are going to learn the various factors affecting financial decisions. As you have already learned that all the financial decisions in a business firm are categorized into three groups. One is investment decision, then financing decision, and dividend decision. Now first we will discuss the factors affecting long-term investment decision, which is also called capital budgeting decision. The decision relating to short-term investment that will be discussed with working capital management. First factor, cash flow of the project. All the investment activities are expected to generate some cash flows over a period. Now what is cash flows? Cash flows are the difference of cash inflows and cash outflows of a business firm, also called receipts and payment of cash. Now for various purposes, for meeting various operating expenditures, a business firm requires cash, and therefore while investing in such projects or assets, the business firm choose those investment proposal which ensures them better cash flow. The next factor, the rate of return. In normal situation, the project which is expected to give more rate of return, that is to be considered for a business firm. Suppose there are two investment proposals. In proposal A, the rate of return expected is 10%, while in proposal B, the rate of return expected is 12%. Now, between these two, the firm like to choose the second option because there the rate of return is 12%. That is higher rate of return than compared to the earlier project. Risk involved is another criteria or factor to be considered while taking long-term investment decision. Because the risk associated with the project is going to influence the firm for a long period, or in investment decision, in long-term investment, the firm incur a heavy expenditure, and therefore they need to calculate the risk and understand that where the risk is high, if the firm is not having that capacity to undertake that risk, then they try to cancel that particular project. There are some other investment criteria like availability of raw materials, technology, etc., which also influence long-term investment decision of a business firm. Now, all these factors need to be considered in case of investment decision is because in long-term investment, the business firm have to incur a very heavy amount, and that amount will remain blocked for a very long time, and therefore they need to take long-term investment decision very carefully. Let's discuss the factors which affect financing decision of the business firm. Cost of raising funds. Now every fund means in every source of fund a cost is associated. The cost of each of the source has to be estimated. So which source is cheaper or which source will cost more to the business firm, all this need to be estimated by the business firm, and after that they will decide that how much amount to raise from which source. Risk associated with the sources. Different types of risk also associated with different sources of fund. Now, when the firm procure more fund from debt finance, then the financial risk increases. Flotation cost associated with a source. This is another factor that is to be considered by the business firm. So flotation cost is the cost which is associated with raising fund for the business firm. It is the cost incurred by a company in offering its securities to the public. For example, underwriting expenses, there may be some legal fees associated, then registration fees. So if this flotation cost goes on increasing, then the firm have to take the decision that they will take those source of fund where the flotation cost is low. Cash flow position of the company. This is another factor. With stronger cash flow position, debt financing is preferable to equity financing for a business firm. Already we discussed that cash flow is the difference of the cash that from cash inflows and cash outflow. If there is more cash available in the firm's hand, then the firm can go for debt financing, and if that situation is not, then they can prefer equity financing. Now why this that is quite logical. The reason is that in case of debt financing, firm have to pay fixed charges or the interest for debt financing. Now with equity financing, the firm can avoid all this situation, because whenever there is profit, the equity shareholders will get dividend. Whenever there is no profit, then equity share have to suffer. Equity shareholders, they have to suffer the losses. So in that case, the obligation of the company do not arise. Fixed operating cost of the firm also affect financing decision. If the firm has high fixed operating cost, then better to reduce debt financing as it has fixed financing cost. So fixed financing cost already we discussed, that is the interest amount which have to be paid by the business firm on the debt financing. Now irrespective of the situation of profit or loss, the firm have to pay that cost. Now these two situations are competing situation. Fixed operating cost and fixed financing cost. These two are competing situation. If the firm have to incur very high fixed operating cost, then other side they have to reduce. So what they will reduce? They will reduce sourcing from debt sources. Control consideration is another important criteria in financing decision. Now, in the hands of the shareholders, the control or the management rests. If the firm's control or management is decided to keep intact or not diluted, then debt financing is preferable for the business firm. The state of capital market influence the business firm in deciding from which source to raise the fund. When capital market is rising or when capital market is growing, it is easy for the business firm to get equity funding, and fund is easily arranged. So coming to the factors affecting dividend decision, amount of earnings. If the firm's earning is more, then it is easy to take dividend decision. Why? Because they have a lot of earning, and therefore they do not have to think much of uh, the two competing situation. The two competing situations are that One is how much amount of the profit they will distribute as dividend, and the other is that what amount of profit they will retain for further investment in the business firm. So high earning, so easy to take dividend decision. Stability of earning. Stability means that the earning of the firm is stable for a period. Means the earning is not fluctuating much. Means say last 3 years, 4 years, 5 years, they are earning a stable rate of return or stable earning. So if their earning is stable, then they are in a better position to declare higher dividends. Stability of dividend. Stability of dividend refers to the payment of dividend regularly and not much alteration in the earning per share. Now that is mostly expected by the shareholders. They like a regular dividend come to them, and therefore to maintain that status, the company or the business firm is paying the dividend at a stable rate. The firm need to also see the growth opportunities in front of them. If the firm has potential to grow, then more amount of the profit will be kept for further investment. That is, they will keep more amount as retained earning. The cash flow position of the business also affect dividend decision, because if they have enough of cash, then they are in a position to declare dividend, means better dividend. Shareholders preference. If shareholders expect that at least a certain amount to be paid as dividend, the firm is likely to declare the same. Taxation policy is another important factor that need to be considered. If tax, that is dividend distribution tax on dividend, is higher, it is better to pay less by way of dividend. The stock market reactions. The stock market reaction is all about sentiments of the potential investors. The possible impact of dividend policy on the equity share price is a factor to be considered. In general, investors view increase in dividend as a good news, and this good news impact the stock market. Access to capital market. Large reputed firms have relatively more access to capital market, and so they can distribute more amount as dividend, and they tend to depend less on retained earning for future. Legal constraints. The provision of the Companies Act relating to dividend payment to be followed by the business firm while taking dividend decision. As per Companies Act 2013, there are some provisions, or they're giving some alternative scenario where if the company is in preceding 2 years or 3 years, they are giving say dividend of 6% or 7%, then maximum this year maximum they can declare dividend of 6%. And those companies in preceding years they have not declared their dividend, so in the current year they can declare any rate of dividend. So these are some of the factors that a business firm need to take or need to consider while taking the financial decisions. So with this we are concluding today's session. In our next session, in our next tutorial, we are going to learn a new thing, that is financial planning. Thank you.